Good morning, everybody. Thank you for joining the ACA Small Business Bootcamp. We will get started here momentarily. We're just letting everybody get loaded into the Zoom app. All righty. Good morning, everybody. Thank you for joining us today on this July 1st. It's a new month and excited about that. I'm Robert Theobald, Small Business Ombudsman and Vice President of Small Business Services at the Arizona Commerce Authority. And we're excited to have you here with us today. As we like to do when we start these, we like to recognize all of our community partners. Our community partners provide the expert content. They provide their time and their effort, their expertise to bring these boot camps to you. We appreciate them very much. As you can see, we have quite a few community partners with us. The Small Business Boot Camp is designed to help small businesses return from the COVID crisis stronger than ever. And as you saw by that list of community partners, it is a statewide initiative supported by well over 100 different community partners. And one of the great pieces of this is our resource collective and our content library. And let me share a bit of those with you here shortly. But on the bootcamp website, you'll find the session that you registered for example, today's session. You went there to register for it. You also find the upcoming sessions. We've got a number of the future weeks listed on there so you can register and see what we have coming up. But as you scroll down to the middle part of the website, you'll find our Resource Collective link. And when you go to the Resource Collective page, you'll find guides and tools and resources provided by many of our community partners to help support small businesses during this time. You can find resource guides for construction, manufacturing, restaurants, retail, cosmetology, etc. A lot of great information available to you. There's even some tools on there that our community partners have put together specifically to help small businesses that are non-branded. So you can just print off some of those tools to help you out as well. Additionally, we have our small business content library. And this is a byproduct of the bootcamp series. We've been doing the bootcamp since April of 2020. We're in our 60th week, and we record every session of the bootcamp series. And then we post those onto the archive section on the website. And what that has done is it's created a massive content library of over 140, I think we're up to about 150, 155 recorded sessions of expert guidance, information, tools, resources that can help small businesses in just about every aspect of running your business. And this is, excuse me, the content library, the archive is available to you at no cost. You can go on our website and access it anytime. If there's a webinar you like from there, you can share the link with a friend that you might want to recommend watch it or whatnot. It's a great tool available to you. Additionally, the state has a number of other websites that are very good to know about. First is the state's COVID-19 information and resource page, arizonatogether.org. And then the ACA created the COVID-19 business resources website at azcommerce.com/COVID-19. And on that website, you can find additional business guidance. You can find links to funding resources that are out there at the state, local, and federal levels, and other great information. Also, the ACA has a number of programs to help support small businesses during this time. Our Small Business Services is available. Our Workforce Division has programs for employers as well as those looking for work. And our Arizona MEP, our Manufacturing Extension Partnership, their team can help manufacturers in many different ways. Additionally, a lot of people are looking to start small businesses this time. They're tired with working for somebody else and they want to start their own business or start their own side gig. And we have our small business checklist that can help you start, operate, and grow your business. On there, you can find the commonly requested licensing information at the local, state, and federal level. It is a great resource available to you. Again, no cost. You can go to our website. And you can also print out the results from the checklist and save those in a PDF format. So some quick business updates. This morning, I was reading an article about PPP forgiveness. And as of the end of May, I think it was, there was still more than 2 million PPP loans that had not applied for forgiveness. So we want to make sure everybody is aware that if you have a PPP loan, which is different from the economic injury disaster loan, the EIDL loan. If you have a PPP loan, you need to get with your vendor to apply for forgiveness. It does require an application to get forgiveness. If not, it turns into a regular loan. Also, there's some great information we'll link to is on the employee retention credit. This is a credit that your business can get. There's some things you have to follow and know how to do, but there is a significant amount of money available through this program. We've had a couple of previous boot camp sessions on it as well. Additionally, for certain businesses that are eligible, the EIDL Targeted Advance is opened up, so you can go to the website, the SBA's website, and get more information on that. And then we've included the SBA Arizona District Office website link. All the links for these programs will be posted in the chat, so take a look at the chat and you can find that. So let's look at some of our upcoming sessions. Next week, we've got a two-part series, 2 individual webinars, but together they make a great series on getting on the first page of Google and how to beat your competition, working with SEO that works, and then content marketing that works. So 2 great pieces. We're looking forward to that. And the following week, July 13th and July 15th. July 13th is Social Media as a Cocktail Party. I'm really excited about this session. We've got a great new presenter who's going to be with us for the first time. We're really excited about having him on our webinars. And then on Thursday, we are partnering, Thursday, July 15th, we're partnering with Google for another Google Analytics session on making better business decisions with Google Analytics. So we've got an exciting 2 weeks coming up, and I hope you can join us for those. So with that, I'm going to go ahead and turn the time over to our presenter today, to Tiffany Visconer of the Ascena Consulting. She's a CPA. She works with our innovation team and our venture ready programs, and we're excited to have her with us. When I was talking to her about this presentation, she shared a lot of stuff that I just had no idea that was available to Main Street small businesses. So we are excited to bring her onto the boot camp and have her share her expertise. So Tiffany, I'm going to stop sharing and let you get started.
Awesome. Well, thanks for the intro, and I'm happy to see everybody here this morning. And thanks, Robert, and also Faith in the background for all you did to get this up and running. I know it takes a village to run a business, so everybody's lucky to have you, the resources, and the community partners. So I'm happy to be here. I'll go ahead and do my best to not fail at the tech thing and share my screen. And please let me know if, let's see here.
While Tiffany's pulling that up, if you can put your questions in the Q&A box at the bottom of your screen, we'll be able to get to those during or at the end of the presentation. Tiffany's screen looks good, so we're ready to go.
Thank you for the confirmation on lack of failure for the first step here. But thanks again, everybody, for being here. Really, the Research and Development Tax Credit program at a federal and the multi-state level is really what I spend the majority of my time doing on a professional level. And then also personally, I'm incredibly interested in the pathway to innovation and finding ways to make sure businesses are supported by doing the work that they're doing and just kind of understanding different ways to frame the things that exist that help you to continue to do the things that you're trying to do within business. So the R&D tax credits is a really lucrative business tax credit, and it's one that's widely misunderstood. So I spend a lot of time chatting about it, and I am more than happy to be interrupted during this presentation. So if you do have questions, if something piques your interest, if you need more clarity, please feel free to throw those questions in the chat as we go, and we can have more of a conversation as I move through. So the idea really with when you think about research and development, or when you think about growth in general, is in today's climate and business, it really is impossible to stay stagnant for too long. So the idea of continuously reinventing something, looking at things from a different lens, figuring out what's going on in the market and the global marketplace, and trying to figure out a way to position your business in a way to continue to be both successful, sturdy, and then grow. So the idea is the transformation points, those pivot points, and the questions likely as a business owner that you go through internally and with your team on a daily basis. Those are kind of the things that we'll dive into to figure out what kind of solutions are you coming up with, and does that fit within what the IRS considers their qualification standards for the R&D credits, and then obviously also at the state level. So what I'm going to start off with is two general but kind of opposing case studies, just to kind of ground it in what this thing looks like. And hopefully some of this will resonate with your business. And when we start to dive into kind of the different intricacies of the credit and what counts and what doesn't count, as we start to discuss through that stuff, if there's specific industries that you guys are in, feel free to throw that in the chat box and I can address those as well. So the first case study I wanted to chat through is actually an AV company. So the reason I picked this one is this is a client that we work with that really was outside of the general idea of what you think R&D is. So they're an audiovisual company. They had to design pretty intricate systems to be able to go into the administrative buildings of hospitals. And they were kind of tasked with being able to use things that currently existed. So though they weren't actually manufacturing the hardware or developing the software components necessarily, they had to create an integrated system. So within that, the communication between all of these things that already exist, to be able to create a design to make it all work together, to be able to code the script to actually create the decision process on what is going to be the best solution for this particular design and what the client needed. So they went through several rounds of design iterations and ended up failing at some of the things they tried to do, had to start from the drawing board again, and essentially created a whole network of something that really hadn't been seen before. And so from that perspective, that was kind of the R&D activity that they were focusing on. So from them specifically, just in a quantitative standpoint, their labor for their qualified expenses were about 1.4 million. And the materials they used in order to go through that experimentation process was about 18 grand. So the translation point from there is for the R&D tax credit on the federal side, they landed over 100 grand in federal tax credits. And then in Arizona, over 160 grand. So the total benefit in that scenario was about 270,000. So on the flip side, now, and this is what because I do a lot of mentorship in the community in general, and I deal with a lot of startups from concept inception all the way through to building out MVPs before they're in a revenue position. This is something that I see quite often. And honestly, this is a place that I like to make sure to insert education to structure things as the growth process starts, so that things don't get missed as they're happening. So this is an example of one of the software companies that I work with. They really were established about a little bit over a year ago. So in that, they're not in revenue, they don't even have a product, right? So they're still building out their MVP. They're going through different iterations on building out a platform and the initial wave in their roadmap. And they have no sales. So from the perspective of, well, what does any of this mean to them if they're actually not making money yet? The fact is they have expenses. So they got funding. They were able to spend money on the developers. And really at this stage, there's nothing else typically being done within an organization. They're trying to build this thing. They're putting all their resources into it. So from a labor perspective, they were at about $500,000. They also utilized independent contractors within the US to be able to help with the development at about $250,000. And then had some materials and some cloud hosting costs that were important and critical in that development process. So again, this is just within the parameters of one single year. And the federal payroll tax credit that they were able to get was over 50 grand. And from an Arizona perspective, they were able to get 60 grand. So the total benefit for them was about 113 grand. So remember, this is a company that's not making money, that's not paying taxes in the sense of income taxes, but they were still able to get this benefit right up front. So hopefully that helps just to show a little bit of a difference between the structure and the growth, where a company is in their growth trajectory, and how we can kind of use these credits to give them some benefit. So, okay, any questions coming through? I see red dots, but anything coming through so far, Faith or Robert?
Yeah, we have one question. It says, are there also Arizona-based grants for research into products to improve sustainability in the home and agriculture?
Yeah, so there is a bunch. I'm going to focus a little bit more just on the R&D side, but even within that description, the R&D credits are actually designed to help with sustainability projects as well. So I'll kind of dive deep into here, but can definitely have another conversation about the multitude of grants that are available on the outside as well.
And for Mark, real quick on those agriculture grants, check the USDA website and grants.gov for those grants.
Awesome. Thanks, Robert. Okay, so the initial starting point and what I notice when I kind of start talking to businesses and also other advisors, consultants, other CPAs, the initial question is trying to figure out what this R&D thing is and actually what kind of businesses can qualify for it. So the idea at a very fundamental level is, what are you doing internally to make your processes or products better, faster, cheaper? And the idea of creating improvements will often put you in front of a threshold where you have to make decisions on how to create something that's better. And so when we talk about industries, this really isn't something that is an industry specific credit. It's an activities based credit. So when we go down the rabbit hole a little bit and look at your specific circumstances, a lot of things that we're trying to kind of extract are, what were the challenge points? What were your pivot points? What additional things were you trying to implement basically to make things better? So the relevance in a global marketplace obviously is that pressure of competition, that pressure of making things better so that you can differentiate yourself. And then also the underlying back end of the activities that go into that and the humans that drive it. So from like an overall perspective, just to create grounding points, the R&D tax credit program at a federal level has been around for over 40 years. So if you can imagine, there's been a lot of big business beat up through case law throughout those years that have created a lot of clarifications. But really from the beginning point, the initial and even now, the whole point of the program is to incentivize US-based businesses that are taking some kind of financial risk to do something that's just out of reach. And it's a two-way street when it comes to kind of the incentive and what's being rewarded, because from the perspective of the government and our country in general, we want to maintain a certain amount of competitiveness in the global marketplace. So if we can, and again, we as in the government, which is not me, but as a country, if we can incentivize our businesses, our small businesses, to be able to build things that keep us relevant and competing in a global marketplace, we're able to keep jobs employed, people employed. We're able to keep the employment numbers up. We're able to keep some of that financial resources within the borders of the US. So this is really designed for US-based labor, US-based independent contractors, US-based spend, and US-based businesses. There is global R&D credits in other countries, but obviously the one that I'm talking about today is going to be the one grounded here in the US. So the intent behind it is really to create a little bit of an incentive to keep taking those risks, with the understanding that anytime you try to do something that's just out of reach, the opportunity for failure and the opportunity for financial loss is relatively high. So how do we get businesses to keep doing those things while giving them a little bit of a buffer in order to continue to feed that pool from a financial perspective? So when this initially came out 40 years ago, it was really geared more towards big business. And it really wasn't until the PATH Act of 2015, so it's relatively recently, that it became something that became more clarified and usable for small businesses and even startup businesses. So before that, it wasn't a permanent part of the tax code. It became permanent in 2016 when this act was enacted. And it then created three primary shifts, which allowed us to use this and focus on this as a planning tool, where before, when it would sunset every year, it was harder for smaller businesses to even put resources into trying to claim a credit where they weren't sure if it was going to exist at the end of that year. So big businesses really got the majority of the benefits from the program until that time. So when that shifted, the second case study that I brought up this morning was related to the startups, right? The pre-revenue businesses. In the PATH Act, that was actually something that was written in to allow businesses that are not in a taxable position to utilize tax credits initially against payroll taxes, which is huge. So if you have a software company, a tech company, a business in general that's spending a lot of upfront cash in order to build something that may or may not come to fruition, they need humans typically to do it. So if they have wages, we're able to take that credit and actually offset the federal portion of payroll taxes more immediately than waiting until they get into an income position. And I did mention this before, but it is a credit that exists against all industries. There really isn't anything that gets immediately carved out based on industry. It's just based on the activities that are most likely to happen. So we'll kind of go through some of the most common industries, but it really is something that I continually get surprised about, even going into businesses that I think may not have too much. But once I start talking through the leadership team there, the owners or the founders, they'll usually bring things up that are able to get attached just based on the complexity and the technical skill that they need to employ in order to come up with solutions. Okay, so then from a benefit perspective, this is a federal credit. So this is something that any state within the US, you'll be able to employ at the federal level. And then from a state level, most states will also take their own take on that credit program and decide whether or not they want to use that at a state level. And I do want to say immediately that Arizona is really one of the best states in the nation when it comes to the credit, which is why I'm happy to be here and working with a lot of local businesses, because your percentage of return while working within Arizona and having a team in Arizona is actually much better than what you get in a lot of the other states. So, all right. So from the general qualification standpoints, I do my very best not to bore or put anybody to sleep by speaking IRS code, but I do like to extract things and try to insert them in a way that makes sense. So from the perspective of figuring out qualification standards within your business, the initial conversation is going to evolve around the activities. So the idea is we want to make sure that we can qualify based on what the IRS calls their 4-part test, which is just basically checking the box to make sure that you can qualify based on the IRS regulations on what does it mean to be R&D, what does it mean to do research and development, and that all starts from an activities basis. So the initial question is really, what is the business component? So the important part of this, and this is the first part of the test, is really within your business, what are you doing to develop a new or improved product, a process, formula, technique, software, invention? And the idea is you have the intention to make this be available to customers, a third party, either for sale or use. And the concept behind that from an intention standpoint is you can intend to create something and fail, and that still counts. You can also have a long runway to be able to get to the point where you can make something that's usable by customers or a third party. But the idea is that you're creating something that's going to be of greater benefit than just internally in your organization. And even though that there's an ability to extract like internal use software, things that you develop internally that you don't intend to have be used by other people, there's a different threshold of innovation testing that we have to go through in order to qualify those things. So from an initial standpoint, the regular credit, what is it that you're creating? What are you trying to create from a functional standpoint that is new or improved to you? And the to you part is important because this is not something that requires a patent. It's not something that you need to do that's new to the world. It can actually be something that your industry is currently doing, but because you have to figure out how to do it internally on your own, the resources, the time, the iterations that you go through in order to try to get it to fruition is really what we're focusing on. So from that standpoint, that's that first question, what is the business component? What is this thing that you are trying to make new or improved? And then the second question is, at the beginning of that project, what kind of technical uncertainties did you have? And these can come in all shapes and sizes, but the technical uncertainty standpoint is important because it's also not an aesthetic question. It's not an aesthetic uncertainty. You want to make sure that there is some functional component that you're trying to figure out. So the identification of those often comes in the form of questions. If you're building out a platform, the way that you're going to design that is something that is important to figure out, something that isn't always readily available in the front end. You have to go through the process of trying, failing, doing it again to be able to come up with your final solution or to throw the project out altogether. So when we talk about technical uncertainties, there's 3 kind of buckets that we'll focus on, and it's like your uncertainties are related to the design, your uncertainties related to the method, or your general uncertainties related to your capability. So do I have the capability or the staff or even the knowledge to do this thing? Is it so out of reach that I'm not sure if I can get it done? Or I know we can get it done. We have the brains and skill. We're just not sure the best method or design. So from a question standpoint, that's the stuff that we'll dive into to kind of drive now what is considered the experimentation or heart of R&D. So you ask your questions, what are your options to look at? And then you go through the cyclical process of trying to answer those questions. So similar to the scientific method. It can be ad hoc. It can be something that you know that there's 3 or 4 ways that you can do this, and you try to go one direction, it doesn't work, you go the other. So it really is the question process, and then the answering process at a very simple level is what is considered the R&D part. So the other critical piece, and this is the part that will typically, when you talk about business trying to come up with solutions, a lot of times in a day-to-day conversation, that's what we do as business owners, right? We come up with an issue, we have to find a solution, we talk through it, we figure out what the best option is. So there's going to be a segregation between general operational conversations to increase efficiencies, and then reaching up to that level of R&D, which needs to involve the principles of hard science. And in that, it's not that you have to be a hard science business. It's not that the hard science part of it means that you need to be in a lab coat in a lab, trying to figure out the next, the next solution to whatever issue we have from a health perspective. But really what it is in that process of experimentation, there has to be the utilization of some hard science. So that's engineering, computer science, biology, chemistry, physics. And that part is what's going to differentiate from doing a general question solution process and something that will elevate to R&D. So for example, building out a SaaS platform and coding, that's going to hit that computer science element. Engineering, when it's civil engineering, structural engineering, data engineering, I mean, engineering in general will guide a lot of these conversations that we have too. All right, so if that's kind of from an activity standpoint, a project standpoint, those are the initial questions, then really the starting and ending point for R&D begins at concept inception. And the reason why early conversations are great to have about how to kind of structure your R&D efforts is because this is the hardest part to capture. So most of the founders I'll talk to, most of the people I talk to are brilliant, right? So you're continually thinking of new things and new ways to do the stuff you're already doing. The bubbling brain is really where those initial conversations happen with clients, prospects, with strategic partners, with your team, with yourself. So when you start to design what this new thing is going to look like, whatever it is that you're focusing on, that's kind of where the R&D clock starts. So the initial napkin sketches, drawing out that brainstorm, figuring out what this design is going to look like, that's going to initiate this process. So then when you start going into the actual experimentation process or evaluation of alternatives, that's kind of the heart of R&D, and typically that's where things will stay for a while. You go through your iterations, evaluation of alternatives, you go through the testing of your uncertainties and try to come up with a solution. The moment you get to the point where one of two things happens, one, you realize this whole effort was for naught and you need to toss the project because it just wasn't working the way you thought and move on to something else. Or you need to shelf it because something else popped up that it requires your attention, that you're going to focus on that first from a development perspective. Or you get to the point of commercial production or release. Like for a initial version of the software, the moment you release that, obviously the next day you're starting on the new things. But the moment you release it for the first time, it's available for sale, available for use for customers, that'll stop the clock. Same with manufacturing. The moment that you kind of have that product up for commercial production after you go through your initial QA, that's going to be something that you'll stop the clock. But as hopefully is bubbling in everybody's brain on the phone, the moment you release it, you're going to usually bring it back to the drawing board relatively quickly to create something new or even more improved on top of that. So typically it doesn't stop at that moment, but then we would start a new project when you bring it back to the drawing board. So I'm just gonna...
Tiffany, I think there's some questions that tie in right with that,
Okay.
with what you were just talking about. So one, Mark says, can these tax credits be used by new companies who are doing research without cash flow?
So new companies doing research without cash flow. So really good question. So this is part of the conversations I like to have because it's kind of proactive strategy to optimize. If there are no hard expenses and no cash actually going out the door anywhere, there's nothing to quantify for a credit. Sometimes what ends up happening is people have multi-entity structures, or they start with a consulting company and then they start another business to start this new idea. Sometimes if we can have conversations early, we can figure out a way to make sure expenses are staying with certain entities in order to drive the credits in that entity appropriately. But the simple answer is if there's no actual hard expense, there's no way to drive the credit.
Okay. And then there's another question from a different person that says, software development in regards to R&D, at what point does a product feature go from being R&D to maintenance?
Yeah, and that's a really good question. So the idea is the functional component has to be able to be identified, and that process of experimentation still has to be adhered to. So certain carve outs within the code are definitely carving out the what they call bug fixes. So anything that is just general maintenance where we can't tie to a new feature, a new function, a new question is going to be hard to support. But even with that being said, a lot of times people internally will use the words bug fix where it's actually not what's happening, where they identified an issue and then they actually had to come up with a full-blown solution in order to address a functional issue within the platform. So those conversations will likely be able to drive a little bit more of that. We do kind of have this 80% threshold. So depending on a project or whatever it is that you're kind of focusing on as far as a new feature, as long as we can kind of support that particular effort, and the majority of that is spent on a functional improvement that we can put through that 4-part test, we'd be able to pick it up again. But what I noticed too is usually the roadmaps, there's such a build out after initial release of things that will need to get added through phases through the development, that there will be definitely points where there'd be enough effort attached that it would rise to that level. But we can also bifurcate. So it's like you kind of go in and just figure out who's doing what, who's spending time on what, and in that project, what part of it will we be able to pick up. I hope that makes sense.
That's all of them for now.
Okay. I was having arrow issues, so thank you. Okay, so then kind of to lead right in from that point, when we talk about hard costs, there does have to be cash outlay or expense outlay in order to quantify the credit. And then how we do that is based on really 3 basic buckets. So the simplicity is, and we have 3 buckets, basically. The hard part is figuring out how to allocate certain things into those buckets based on qualified factors. So in a very simple way, the 3 things that we can pick up for costs are wages, contract research, which is your independent contractors, 1099s, and then supplies. And then in supplies, there's also a little caveat for computer rental costs as well, especially when you're in the software space. So from a wage perspective, it is US-based labor. So as I mentioned before, this is something that's really heavily designed from a government standpoint to be able to incentivize US-based labor instead of outsourcing. I do want to say though, because this comes up a lot, there are some businesses that I'll work with that have some dev teams that are overseas. If you have a dev team overseas, but you also have a team here in the US, it doesn't preclude you from taking the credit. We just cannot pick up the stuff that's sent overseas, the cost that's paid overseas. So just to make that differentiation, it doesn't throw you out from taking the credit. We just can't pick up that cost. So from a wage perspective, it's actually 3 levels. And so when you talk about the actual technical folks, the ones that are doing the dev work, the ones that are engineering, the ones that are fingers to keyboard getting the things done, but it's also 1 level up of supervision and 1 level below of support. And depending on the size of the organization, that can really pick up a lot of people within that time frame of concept inception to release. So those type of activities is basically going to drive a certain amount of that person's wage, which then gets thrown into a grinder to create the credit. So when we talk about the humans involved, a lot of times it's going to be even sometimes stuff that gets missed is the front end BD team, the team that's talking to prospects, because a lot of that feedback loop on how do we make this better is going to initiate through those conversations. Like, what do we need to add here to make sure that we're continuing to stay, again, relevant and competitive? So from a wage perspective, those are kind of the 3 main categories. And typically this is going to be the primary driver of the credit, just because wages are typically one of the higher expense points within an organization. And then also contract research. So it would be the same thing as we talked about with wages, but this would be somebody who kind of functioned as an employee, but is an independent contractor at 1099, somebody who's not actually on payroll, but that serves a function within that R&D timeline from concept inception to release. A lot of times initially when you're starting an organization, there'll be a lot of use of independent contractors to help until you're able to pull on a full-time role. So we just want to make sure those things get picked up as well. And then from a supplies category, if you're in product development, manufacturing, a lot of these things are going to be your tangible, non-depreciable items that are burned up in the process of experimentation, of prototyping. It's not the big CapEx expenses, it's the things that you actually use in order to build out prototypes that you use and through that process of experimentation. When we talk about when we talk about software development, there's not a lot of hard costs like this or hard things that you need unless there's also a hardware component. But from the software perspective, your dev space and the cloud hosting costs, there's a thing in the code called computer rental costs, which back in the day you actually had to rent the mainframes. So now it's all in the cloud. So a lot of those costs like AWS or Azure that are used in order to house the development space, we can pick those up as well. All right, so with all of this pie in the sky stuff, so what ends up happening just from a general flow is there has to be an expense. If there's an expense, we figure out the qualified activities and then attach those expenses to them. Then with that, it becomes the pool, and that expense pool will then get funneled into different calculations, which will then spit out a credit amount. So the benefit of that credit amount is different than a deduction. So when you think about the things that are deducted from your revenue amounts to get to your net income figures, a lot of times those are going to reduce the amount of your taxable income, and then your tax rate is applied to that. When we talk about tax credits, the difference is instead of just taking that deduction and reducing your income figure that gets hit with tax, you actually directly offset the tax amount. So if you had 10 grand in deductions, that's just going to reduce 100 grand revenue down to 90, and then the 90 gets hit with the tax rate. If you have 10 grand in credits, say you have 10 grand in taxes to pay, you no longer pay that tax. So from an impact standpoint, credits are always more lucrative than deductions. And then even better kind of in this scenario is you are getting deductions and you're getting a credit for basically the same expenses that you took a deduction on. So from the perspective of you're not going out to create new expenses, this is stuff typically that you're paying for anyway. And we're able to identify, extract, and then add that additional benefit of knocking out taxes. So dollar for dollar reduction in income taxes, it's more lucrative than a deduction. And then the payroll tax offset for pre-revenues and startup businesses. This is something, as I mentioned, came into play in 2016. And it's still something that's a little misunderstood and gets missed often because people usually, if they know about tax credits, they think, okay, well, I gotta have taxes. I need to be paying income taxes to use it. So this is something that is really, really valuable at the beginning stages. So what we're able to do is go through the same process to generate a credit, but then make an election. So if you're not making taxable income, you don't have revenue, you're not paying taxes, which is great from an income perspective. But if you do have payroll, we can go through the same process, take that credit, and now choose for that year to put it against your payroll taxes instead. And there's two things that are really great about this. One, you get the benefit sooner in the sense of as soon as you file your return the next quarter, we're able to kind of take that and offset the federal portion of your payroll taxes. And then two, you can actually use it in a way where you're reducing your spend before you even get to a revenue position, which is very nice. And then obviously, as we kind of go through the idea of how to position this in your business and keep track of it as you go, you're able to find ways to fund future growth, or at least have conversations about strategy. Where are we going to put a lot of spend, knowing that, you know, in Arizona, I'm going to get 20% back on whatever I spend towards R&D. Then I'm going to make sure that I try to zone in on what's qualified, but how to optimize this. And even if it's for this year where I put a lot of effort into developing something, at least I know that's going to be my return. All right, so another part of this, which is cool, is when you go for the R&D tax credits, there's also a look back period. So if we didn't have this conversation or this didn't come across your radar and you're thinking, oh my goodness, I probably could have done this in the past, we do have the ability to go backwards in time to collect R&D activities and quantify those for past years. So kind of what that looks like is from a federal level, there's 3 years based on your data filing where the statute of limitations is basically hasn't run yet, that we can go back, claim credits, and generate refund checks. For current and future tax liability, the idea is to do that proactively. So we have an idea what your credits are before the cash goes out the door. And then in that perspective, really the two ways of benefit are either recouping cash as a refund or stopping cash from going out the door in the first place, keeping it in your pocket so you help to increase cash flow. All right, so optimization strategy around this kind of stuff is really where I geek out the most, just because, like I said, a lot of businesses don't realize they're doing R&D. They don't call it that. They're doing the thing that they need to do to survive and to stay relevant, and don't realize what needs to be captured is likely something that they're already doing. They're already paying for. So figuring out a way to kind of capture that as you go, create the paradigm of understanding, hey, you know, what I'm doing is actually something that qualifies for this. So is there a way for me to structure my team or myself to make sure I don't miss out on these opportunities while I'm in a heavy development mode? And then the idea is you have a business, there's something that you're focusing on. And I'll give an example just to ground it. So for example, I've worked with a bunch of supplement companies. So the formulations of different supplements is part of that R&D process, right? So figuring out how to put the actual ingredients in these things to get a desired result. So in that process is R&D. But then what happens next? You got to manufacture these things. So in the manufacturing process, because R&D is focused on that business component of process or product, formula, technique, software invention, there's another element of R&D, which is that process of manufacturing something the most efficient way possible, how to get the best yield, how to utilize new technologies in order to create a better manufacturing line. So you have the development of the product, you have the development of the process, and then on the back end, we want sustainable packaging. We want to make sure that we're using materials that are basically quickly biodegradable. But going through that process, if anybody's done that, can be very time consuming too, because you also want to make sure that it's durable. So how do you create sustainability and durability at the same time? So that is just like three components of one business. And then on top of it, they wanted to build out a client portal in order to make sure that they could track the process of someone's order. They make sure that they had customized build outs as far as the type of supplementation and supplements that they wanted. So from a standpoint of building out that actual platform, there's a whole nother area of R&D. So the low-hanging fruit is typically the primary thing you're focusing on in a business, but once you start to dive in, you'll start to realize that there's actually a lot of things we're doing here to create a newer, more efficient way of doing things. And then those are the things that would get extracted. And then from a capital allocation strategy, again, just understanding what the returns look like. It's going to help to at least have an understanding of where to put resources, and the timing of where you are in growth is a really critical conversation to have as well. And one of the things that happens a lot when I have these initial conversations is this understanding of rights and risk. So disclaimer, I am not a lawyer, so I'm not giving any legal advice in this conversation, but from an R&D perspective, there's certain things that need to be true in order to make sure a business is able to capture R&D for themselves. And whenever you work with a third party, there's a lot of complexity that can happen through contracting or lack of contracting. Hiring an independent contractor and not realizing some of the language actually gave that contractor the rights to what you're doing can blow out your ability, I mean, for other things as well, but just from an R&D perspective, blow out your ability to be able to take the credit yourself. So those kind of conversations up front are great to have, because if you do go into different relationships with providers, consultants, just understanding what needs to be true and then allowing that to funnel through your pocket of advisors is really good. All right, so this is just quick and dirty, but some of the industries that commonly qualify. So from a manufacturing standpoint, it's actually one of the highest industries still in the world that claims the credit. So that process, both of, again, developing the product, but developing the process of getting a product made. So the design of new machines, the use of the materials, prototyping, dyes, tools, molds, things that require, again, that iterative process. And then one thing to notice here too, in case anybody's on the line that's in the contract manufacturing space, because of case law, there's actually a division between the development of a product and that manufacturing process. So a lot of contract manufacturers that don't end up owning the rights to the end product will still own the right to that development process that goes into building out that manufacturing line. So there is an ability to take a credit from that standpoint. So when we talk about who has the rights at the end of the day, who's taking the risk, there are two components that we're able to look at. From an information standpoint, software is huge. So even if you're not a software company, a lot of businesses are building out pretty complex apps, building out different software platforms, building out more robust websites in order to house different client needs. So anytime you have those connection points or spending a lot of money or time to try to figure out, okay, what's a better way to do this? The pivot points in, based on what happened last year and everybody really needing to figure out quick ways to go remote and the associated issues that came up with that. There was a lot of security issues that came up that required immediate resolutions for. There's different systems that were built in your business in general. If you needed to pivot remote, there's probably a lot of things that needed to happen and be true in order to secure that environment. So some of that stuff is also things I'm noticing popped up specifically because of everything that happened last year. And then formulations, so supplements, natural foods, beer, mead, which is a new discovery of mine. So anything that, again, requires that chemistry, like the figuring out how to put things together so that it works. And then professional services. So again, engineering, architecture, you're talking about the construction industry a lot, where there's the design build components. You also have in the professional services arena, like fintech, you have different types of businesses that are just looking for different ways to reach clients, create a more efficient way to do things, secure data. All right, so from my perspective, I implore anybody that any of this hit, feel free to reach out, obviously, to have a question if there's something specific, and we'll go through some questions now, I believe. But really, it's never too early to have a conversation to understand, what do I need to set up, and does this count, and this doesn't, what counts and what doesn't. The thing that breaks my heart on a daily basis is when too much time has passed and either somebody just didn't realize this was something that exists that could help them at very vulnerable times of growth, and or if they got information a few years ago where they were told that they can't do it and didn't really understand why, but then dropped it off their radar. So a lot of times these re-entry conversations will involve unfolding the myths and the maybe misinformation, or as we've all probably discovered over this past year and a half, regulations change on a continual basis. So it requires continuous touch points to make sure that things are getting applied and clarified and put into context in a proper way. So that is me, my spiel. And I hope if anybody has any questions, I see red dots, so.
We do have a few questions. Raymond actually asked a really good one here. It says, are SBIR funded projects handled any differently?
Yeah, that's
the limits to the funding, which covers the expenses and labor.
Yeah, that's a really, really good question. So a lot of the companies that I've worked with that have SBIR funding, the good part is if we kind of go back to these two prongs of who at the end of the day is taking financial risk and then who has substantial rights. Typically from a rights perspective, they're written in favor of the founders or businesses. But typically when I'll review those contracts, the things that I'm looking for are, do you have rights or at least shared rights? Because substantial rights is a critical piece of whatever it is that you're building that you need to retain. And then from the actual payment terms and the risk and development, anytime you're going to get paid no matter what, if you don't deliver anything, then you're taking no risk. But most of the time the SBIRs are, you have a required deliverable. You have something that you need to make sure that you're addressing and actually delivering. And then a lot of times they're on a flat fee basis. So from a structuring standpoint, the IRS looks at like flat fee payments. Like even if you were getting it from a client, paid from a client, if you get a flat fee to develop, what it looks like is you're getting paid for the end product. You're not getting paid for the brain damage and torture you went through to come up with the solution, which is your R&D process. So when there's no overarching exact way to say yes or no, but when I look at a lot of the SBIRs, they are in favor of founders for those two reasons. One, they're typically flat fees. They're contingent on you making sure that you deliver something. And then typically you'll have substantial rates at the end of the day. If you're directly reimbursed, and it's noted that you're going to be directly reimbursed for certain expenses, those expenses would not be picked up because you technically did not pay for them. If you're figuring out a way to use those funds internally where you can blow through that budget and you really have the funding, but you need to put that into resources based on your own accord, and there's not direct relationship between actual reimbursement of funds and what those are, then there's a little bit more gray area to play in. I hope that answered.
Excellent. Another good question on here is, if a company hires your company to design a new product, who can claim the R&D credit?
That's a very, very good question. And this is where a lot of my heartbreak happens. So not necessarily. Okay, so there's two things. I'm going to go back to those pillars again. Just for me, it typically helps to kind of explain. So if you're getting paid to do something, that doesn't necessarily preclude you from being able to take the credit. It's how are you getting paid? So if a company comes in and says, hey, I have this thing that I want you to create for me, and I'm going to pay you for all your time invested in building this thing out. The things that wouldn't be true for you is now you really have no risk because they're paying you for your time. They're essentially, from the IRS's perspective, paying you for your development time. You're paying you for your R&D because they're paying you for your time. You're not at risk. If they come in and say, hey, I'm going to give you 10 grand to build this thing out for me, and you have to go to the drawing board, you're taking that financial risk. It could cost you 10 grand, it could cost you 20 grand, it could cost you 5 grand, but you're taking the risk to develop that. You would then likely be the one that would be able to claim the credit. So it really comes down to terms. And a lot of times these are conversations I like to have because there is a lot of development shops too that will go back and forth between doing time and material jobs and flat fee arrangement or fixed fee arrangement. And obviously there's other operational and business things to talk through based on those two structures. But at the end of the day, who has the risk? So even though you're getting paid, are you taking the risk, or is the client kind of taking the risk? Because if they're paying you time and material, it looks like they're taking the risk and the IRS would lean towards them. The secondary thing I want to say to that point though, is if you are developing things for others, you are on a time and material basis. This is also something that could potentially be a value add conversation to your clients. So if they're paying you time and material, you know you can't claim the credit, but potentially they can, because now what's happening is that risk shifted to them. If it's something where you'd like to continue to do time and material projects and your clients can use the benefit, it's a conversation you can also have with them to have them look into it for the development work that you're doing.
So to go with that, she asks, so a firm fixed price contract is easier to obtain the R&D credit versus a cost plus type contract.
Yeah, and thanks for simplifying my 1,000 words into a sentence. Yes, that's it. So standard typically, yes. So again, the contract is going to do the financial risk component. So that's what we want to look at. There's also a rights component. So you just want to make sure there's no contradictory information or language in contracts that basically say they own everything you learn to build this thing for them. You want it to be stated that they're basically getting an end product and you're taking the risk to develop that.
Okay. And then going back to the SBIR, Raymond asks, how about the cost of any subcontractor listed in the SBIR budget?
So there's a couple components and these get sticky, which is why I like to kind of look at each one, even though there's some generalities that flow across each SBIR. It really just depends on whether or not they're named, again, what position they have within the actual development process, and then how they are getting paid. If it's related to part of your team and you're identifying someone to make sure that they're qualified to be able to use them within that process of development, it's different. If there's direct reimbursement to them, it's going to create a little bit more complexity.
Excellent. Thank you, Tiffany. Well, that's all the questions we've got for now. And you know what? We can go ahead and give everybody back a couple minutes of their day and wrap up a few minutes early. But Tiffany, thank you for this great presentation and helping everybody understand a little bit better how they can go after the R&D tax credits. And we appreciate your time and your effort and your involvement with the ACA, and not just the boot camp, but in the other programs we have. Great working relationship there, so we appreciate that very much. We want to thank everybody for attending today. And just a reminder, we will be back next Tuesday morning, 9 a.m. This is a holiday weekend, so depending on if you're taking the holiday on Friday or on Monday, everybody have a safe and enjoyable holiday weekend. Enjoy the 4th of July, and we will see you on Tuesday morning. Thanks.
Thank you all.